Good morning.
Yeah, okay. So let's start the balance part of the lecture uh, from where we stopped last time. Okay, before we move to the rest of the presentation, are there any questions or anything you need to clarify from previous session?
So one more thing for the clarification.
Yeah.
Under the Basel 2, we have recognized three-pillar approach under which there is a market disclosure.
Yeah.
Actually, what are these areas that we cover under the market disclosure?
I will I will go on these three pillars separately. So then when we come to that part, you will understand what are the areas. Okay.
Okay.
Any more questions? Anything else? No more questions? Okay. So let's, so basically, what I said last time was that how, in fact, what we talked was that how Basel came into effect in 1988. So, and then what was the idea, and then the risk covered under Basel 1. Then why the Basel committee thought of moving to Basel 2 in 2004. So broadly, the scope of the risk covered expanded under Basel 2. Also, in addition to the regulatory capital requirement, also it came up with two more pillars: the supervisory review process and the market discipline. Okay, so we will look at each of those components separately. So basically, under the minimum capital requirements, the scope expanded to cover three categories of risk: the credit, operational, and market. And also, the Basel II suggested different approaches to arrive at the capital required for different categories of risk. That is the three main categories of risk: credit, operational, and market. So under the credit risk, the Basel suggested two approaches: the standardized approach and the internal ratings-based approach. Under the operational risk, it suggested basic indicator approach, standardized approach, and advanced measurement approach. Under the market risk, the two more approaches, standardized approach and models approach. And the quantify capital components remain more or less the same, the definitions of the quantifying capital. The two elements of capital I mentioned, the core capital and the supplementary capital. So the scope of, let's talk about the pillar one, which is the pillar one is the minimum capital requirement, which is about the regulatory capital. Okay. So the pillar one determines the minimum level of capital a bank should hold as a buffer for loss. So the capital equal a percentage of risk-weighted assets. Okay, percentage of risk-weighted assets as given by the Basel Committee. Of course, at the beginning, the requirements I mentioned earlier, internationally it was 4% for core capital and 8% for total capital. But the different countries, regulators were allowed to adopt a different number. I mean, at least minimum that, but anything above that. So that was the requirement. So let's look at the different approaches under the pillar one. For credit risk, the three approaches: the advanced IRB approach, foundation IRB approach, and the standardized approach. So here in Sri Lanka, basically we use a standardized approach. in among our banks, but in many some Western developed countries, many bank regulators allowed banks to use IRB approaches. So IRB stands for internal rating-based approaches. Okay, so basically, I will explain again a little later what those approaches are. Then operational risk, as I mentioned, the three approaches: advanced measurement approach, standardized approach, and the basic indicator approach. But here in Sri Lankan context, we basically adopt basic indicator approach. The market risk, the two approaches, internal models and standardized approach. Again, here in Sri Lanka, most of our banks adopt the standardized approach. Now let's look at the credit risk part, standardized approach. If you look at the standardized approach and the credit risk, is more or less similar to what was highlighted in the Basel I concept. But risk weights are linked to external ratings. If you look at Basel I, how the risk weights were calculated, each asset in the balance sheet is given a risk weight starting from 0 to 100. So there were 5 risk weights: 0, 10, 20, 50, and 100. So then each asset in the balance sheet assigned one of these 4 risk weights, either 0, either 10, 20, 50, or 100, depending on the probability of credit risk. So 0 means what? Risk weight 0 means the probability of credit risk is almost 0, less. So 100% means probability of credit risk higher, almost 100%. Okay. So those are 5 arbitrary numbers the Basel Committee suggested in 1988 when this Basel was enacted. So, but the problem has been it does not take into account actual credit risk of a particular customer. Okay, so let's say a company is giving an unsecured loan to a company. So basically, in terms of Basel I approach, it is 100% risk weighted. So that means that the bank needs to keep capital equivalent to 100% of the asset value, the percentage. So but if you look at 2 companies, which are the bank has given loans for 2 companies, unsecured, in terms of Basel I, there is no difference in terms of capital requirement. For example, let me ask a question now. If under Basel I, bank gives a loan to unsecured loan to company A, 100 million. If the capital requirements are core capital 4% and the total capital 8%, how much capital the bank should set aside for this particular loan given to company A? The loan amount is 100 million. The capital adequacy requirements, core capital 4%, and the total capital 8%. So how much capital the bank should set aside when this okay, for the easy purpose, take the loan is 200 million, okay, 200 million loan. So how much capital the bank, core capital, and how much total capital bank should set aside against this particular loan to cover up credit risk in terms of Basel I approach? Can anyone tell the number? The loan amount is 200 million. The core capital requirement is 4% of the total risk-weighted assets. The total capital requirement is 8% of the total risk-weighted assets. If so, how much capital, core and total capital, bank should set aside against this particular loan?
Is it 16 million, sir?
16 million. Okay. So one answer is 16 million. That is total or co-capital? I asked two questions, co-capital and total capital.
Total capital.
Total capital. How much co-capital?
8 million.
8 million. So one answer is 8 million co-capital and 16 million total capital. Are there any other answers? Anyone else? Anyone else? Any other answers? Some more answers I need.
Is that total 16 million?
Total 16, co-capital?
Altogether, is it because it's total, they say total?
No, I asked two ratios I mentioned.
Yeah.
How much in terms of co-capital, how much in terms of total capital? You said total capital 16. What is the co-capital requirement?
Because we get co-capital 8 million, the total current balance of that one 8 million. So altogether 16 million.
Okay.
Co-capital 8.
Okay. Any other answers? Any others? Okay, let me ask, how did you get 8 and 16? Tell me. And there were two answers, same answer. So how did you all get 8 and 16? Can you explain, please?
%8 and 16% of the loan value, sir.
How do you take the loan value? Yes. Because the capital is based on the risk-weighted assets. Okay. So if the loan value for anything, you are going to take 8 on 60, sorry, 4 and 8. Okay. So how did you get that? I want to consider the risk weight of the particular loan.
That is exposure default into risk weighted. Exposure default is 200 million.
Okay.
Then risk weight is 100%.
Yeah.
Therefore, the risk weighted asset is 200 million again.
Yeah. Okay. So first you have to compute the risk weighted assets. Now in this case, the risk weight is 100% because unsecured loan under Basel 1. So the 100% risk weight is assigned. So the total risk weighted asset value is also 200 times 4% is the core capital, that is how much, 8 million, and times 8% is the total capital, that is 16 million. Okay. So let's take another example. Assume this particular company has a credit rating of AAA. This particular company has a credit rating of AAA. So let's say the bank has given another loan to another company called company B, 200 million. Okay, but the risk, the credit rating of that particular company is BBB. Okay, the first company is AAA, the second company is BBB, but the bank has given the same amount of a loan, 200 million. Then for the company B, how much bank should set aside as capital, core and total capital? for the company B under Basel I approach. Under Basel I approach, now we know how much bank should set aside for company E, but how much bank should set aside for company B?
Is it another 16 million equity portion? Because the risk rating is higher, I mean lower.
Sorry? No, for any loan you have to set aside capital.
What is the risk weight of the second loan, sir?
Again, unsecured loan. Unsecured loan.
Then
Say,
another 16 million.
huh?
Then another 16 million company has to set aside according to Basel I.
Total capital.
Yeah. So altogether for these two loans, 32 million.
Okay. So then what about the credit rating? The first one is AAA. The second one is BBB. Have you factored that into account?
No, sir. No idea about it.
Okay. So that is the key problem in Basel I, because Basel I does not take into account the real risk sensitivity of a particular asset. Okay, so Basel I simply says these categories of loans assign a risk these categories of assets assign a risk weight of 0. These categories of assets assign a risk weight of 10. These categories of assets assign a risk weight of 20. These categories of assets assign a risk weight of 50. These categories of assets assign a risk weight of 100. So basically, the Basel I says, okay, these assets carry 0% risk weight. These assets carry 10, 20, 50, and 100. But it does not recognize the real risk sensitivity of an asset. Now, classic example was the one which I explained to you right now. The two unsecured loans for two companies, A and B, but the external ratings of the two companies are totally different. Okay, the risk sensitivities are different. But Basel I does not take that fact into account. So in reality, in such a case, bank is not effectively utilizing the capital. Now, the previous the example I gave you, whether now if you look at among A and B, which is more riskier or which is more safe? Huh?
B is riskier.
B is riskier. So despite B is riskier, you are keeping the same amount of capital as the less risky company, which is A. Alternatively, okay, for a less risky company, you again need to keep more capital compared to a riskier company. So either way, okay. So that is the weakness of Basel I. The capital allocation was not efficient. So if you look at under Basel II, it's a randomized approach. Still, you are talking about risk weights, but it is linked to the external ratings. So now the risk sensitivity is brought into the picture. Okay. So earlier it was simple 0, 10, 20, 50, and 100 risk weight. Now, still Basel II under standardized approach talk about a risk weight, but based on external rating. So which is more risk focused. So that's why again you need to have external ratings in place when you assess particular assets, particular categories of assets. Of course, for certain categories of assets, you don't have risk weights, the external ratings, so you go by the different risk weights again Basel has given you. Then again, it captures the credit risk mitigation. Again, what is important under Basel II approach was the MIS and IT capabilities, management information systems and IT capabilities in place. Okay. So I will show you a little later how it is in practice. The direction issued explains how the capital is computed, but for the time being, so standardized approach is again risk based on risk weight, but based on external rating, not just simple 0, 20, 50, 10, 50, 100. Then when we move on to the more advanced approaches, the internal rating based approach. Now, internal rating based approach, again, there are two components, foundation and advanced. Okay. So now foundation approach. Now, if you look at these, internal rating based approach is basically a facility or option given to a bank to use their internal models to identify the capital component for credit risk. Okay, so any bank, if it has an internal model developed, then the bank is allowed to use that subject to the regulator's approval to use that model for the computation of capital for credit risk. Okay, so it's a basically internal model, but there are two approaches again, foundation and advanced. So basically, if a bank wants to adopt an internal model, the particular model should capture 4 key components or 4 key indicators, which is given here: probability of default, loss given default, exposure at default, and the effective maturity. Probability of default, loss given default, exposure at default, and effective maturity. Okay, so any model a bank use should have these 4 indicators. Okay, now so it's whether you use foundation approach or advanced approach. If it is an internal rating based model, so these are the 4 parameters. Now, if you look at, I'm not going to explain the technical side, the probability of default, of course, you can use the historical data. Then you can use the loss given default. If the loan default, what is the loss? Okay. Then exposure at default is again how much you are exposed to a particular asset at a particular time, and effective maturity of the particular asset. Okay. Now let's look at what is the difference between foundation and advanced. So in the foundation approach, the bank is allowed to estimate the probability of default, PD, associated with the borrower, and supervisors will provide the data on LGD, EAD, and NIM. Okay. So even though you are allowed to use an internal model under the foundation approach, but your freedom is restricted in the usage of the parameters. How it is restricted? The bank can only estimate PD in their own using their data, historical data. But the supervisor, here the supervisors mean the regulator. Okay, the central banks will provide the other 3 key parameters. Okay, other 3 key parameters. Okay. So anyway, the use of model is subject to the regulator's approval, supervisor's approval. Because if the supervisor is not satisfied with the model which you are going to use, you are not allowed to use an internal rating-based approach model. So the 2 things under the foundation model: the first place, you are required to get the approval of the regulator to use the particular model. And the second thing is, in the case of 4 parameters, you are allowed to use PD in your own, but The rest of the three parameters, LGD, EAD, and M, is provided by the regulator. Okay, so let's move on to the advanced approach. Again, it's same. There is no difference between foundation and approach. Again, bank use their own internal model subject to regulators' approval. So the first thing, anyway, whether you use advanced approach or foundation approach, you must get the regulator's approach and get it validated from the regulator to use for capital computation purposes. But the three parameters can be estimated by your own internal systems. Okay, so all the four inputs, the PD, LGD, EAD, and M need to be estimated by the bank. So bank has given more freedom to use their own estimates for these four parameters. Okay, four parameters. Then you can use the particular model which you built in your own to estimate the credit risk, the capital requirement for credit risk under the Basel approach. Okay, so that is the difference between what you call internal rating and basis approach, the foundation approach, and the advanced approach. Clear? Any questions from that? Okay. So I'll explain.
Excuse me.
Sorry, yeah.
Could you kindly clarify again the difference between now the rating-based approach? We got it. I'm little unclear about the difference between the other two approaches.
What do you mean by other two approaches?
The remaining two, not the two approaches, the standard method and the advanced method.
Now, standard method is you are not going to use a model, internal model. Now here, the IR internal rating-based approach, we are talking about the internal model used by the bank to compute the capital. So the bank develop its own model, like say now, for example, value at risk model. So bank has a value at risk model. Okay, I'm just giving example. Its own model to estimate the capital. Okay, so the regulator does not develop a particular model. Bank has its own model, but the model should consist of these four parameters. Okay, and these four parameters will tell for any particular asset how much would be the capital required for credit risk. Okay, so there is no external ratings built into this one. Okay, but if you look at the standardized approach, here we are not talking about the model. So it's more or less similar to the what you call Basel I approach, where a particular asset, the capital required amount is the percentage of the total risk-weighted asset, but the risk weight is based on the external rating. Okay, so there is no model in it. So if you have let's say you have granted a loan to a corporate, let's say corporate AAA rating, then you will be I will explain when it comes to the particular direction. You will be asked to apply, okay, your risk weight is 20% or whatever. So if you are given a loan to corporate, let's say BBB, your risk weight is 50%. So we are not talking about any PDs, LGDs, and so on. It's a simple approach like Basel I, but the rating, the risk weights are based on the external rating. Okay.
Got it, sir. So basically, under advanced approach, even if the risk rating is same, let's say two BBB companies, the amount of capital we would have to set aside might differ, right?
This approach, standardized approach.
No, under advanced approach.
Yeah, and advanced approach, yes, could be different because anyway, even the foundation approach. Even the foundation approach, because the PDs are different. Okay, so for the different groups, PDs are different. Okay, so whether it's advanced approach or foundation approach, your internal model says, depending on the PD, you plug in the PD of a particular group, it will tell what you call different capital, depending on the different exposure. Because the different groups may have different PDs. Okay, so that again may have a direct, indirect link to the external rating. But this is based on a model. Okay, so model will, I mean, you just plug in a, these 4 numbers, then model will tell this is the capital you are required to allocate for this particular facility or this particular asset. Okay, clear?
Yeah, thanks, sir.
Then market risk defined as the risk of losses in on and off balance sheet positions arising from movements in market prices. So which we already discussed under the market risk. So when it comes to Basel, there are a couple of important things. The risk pertaining to interest rate related instruments and equities in the trading book. Remember, in the Basel, when we talk about market risk, you are talking about the trading book component as well as banking book. When it comes to trading book, the 2 risks we are talking about, the interest rate risk and the equities risk. And the foreign exchange and commodity risk taken from the banking book throughout, whether it's trading or not trading. Okay? So when you talk about foreign exchange risk, you are not just taking the risk arising from the trading book component, but it's a banking book as well. Commodities also same. Now, again, the market risk, again, 2 approaches given, the standardized method, internal risk approach. I'm not going to discuss technicalities of those 2 because it will be complex. But remember, there are 2 methodologies, standardized approach, which is more like Basel 1, credit risk. So you are given some, options, simple approaches to you compute the market risk. But if you look at the direction, I will show you how it is computed, then you will have understanding. Then again, internal model-based approach is again more technical approach, like an internal model, for example, value at risk model. Now you use value at risk model, something like, it's not just a value at risk, you can have any model to compute the market risk. Okay, so that's your internal model you build, but you have to again get the approval of the regulators to use that, and you must get it validated, because the regulator must be satisfied that the model with the bank, because if you look at, there are 10 banks in a particular country, so the 10 banks may adopt different 10 models. Okay, so the regulator must be satisfied that each model is comfortable in giving a right answer, right capital for the market risk. So, so I'm not going to discuss again in detail. I will show you when it comes to direction how different aspects are, highlighted in the direction. Okay. Now, for the operational risk, now the definition is, again, you need to mindful about the definitions. The Basel defines operational risk as the risk of loss resulting from inadequate or failed internal processes, people, systems, or from external events. So it's a wide definition, wide coverage, inadequate, the risk of loss arising from inadequate or failed internal processes, people, systems, or from external events. So that is the definition. Again, 3 approaches. The 3 approaches are basic indicator approach, the standardized approach, and the advanced measurement approach. So let's look at a little bit about the different approaches because these are not very technically related. So the basic indicator approach is basically if a particular, for example, in Sri Lankan banks use the basically basic indicator approach. Okay, so how a bank would compute the capital required for to cover up against the operational risk is defined as average over 3 years of a fixed percentage of positive annual gross income. Okay, so in order to compute the capital charge for operational risk under basic indicator approach, a particular bank has to take average annual gross profit, gross income over the last 3 years, but which must be positive. Of course, if it is not positive, you can't use that. You have to go further back into further number of years. So that's why I have given a definition. So the KBIA equals summation of gross income 1 to n, let's say 1 to 3 into alpha. Alpha is a number, now number is 15% given by the Basel, divided by n, the number of preceding 3 years when annual gross income is positive. Okay. So if you have, for example, if you have, let's say, last 3 year gross income is 100, 200, and 300. Okay, 100, 200, and 300 positive. So the KBIA equal 100 plus 200 plus 300 divided by 3 into 15%. So it's very simple. So bank has to only look at the last 3 years gross income in a positive year, positive gross income year, and average it, that is divided by 3 and multiply by alpha. Alpha is the 15%, which is set by the Basel. So it is a very basic, very simple calculation when it comes to operational risk under the basic indicator approach. Clear?
So excuse, this is not relating to the content we are discussing, but the slides are not moving.
Oh, slides are why? Is it moving now?
No. From the very beginning, they were not moving.
Oh, so you didn't mention that. But can you see the slides in your?
We can see the first slide, sir.
Oh. So this way, can you see?
Yes, now it moved to market risk.
Yeah, but when I want to put it into the full picture, you can't see. Can you see now?
Still we can see, yeah.
Can you see now? Change?
No, there's no change.
Okay, so then I have to go to the simple version and get it. If I go this way, can you see? Without the full slide?
Yes, I think. Now it is at market risk.
Market risk, that standardized method and internal model base.
Yes.
So is it okay if I, without the full slide, if I go this way? Okay.
This looks okay, sir, yeah.
Okay.
Yeah, it's okay.
Okay. So we are here. Let's we went further down. Okay. So we are here. Now can you see? Okay. So the basic indicators approach is pretty simple. So you take the past 3 years where you have positive annual gross income, take the average, so that is divided by 3, multiply by 15%. Clear? Any questions? Okay. So so that is the basic indicator approach. Then standardized approach. Okay. So can you see now standardized approach?
Yes, we can.
So now the standardized approach, what the Basel said, rather than taking the total gross income of the bank, divide the gross income into 8 business lines. Okay, divide the gross income into 8 business lines and follow the same approach. So instead of you applying the total gross income of the past 3 years, average it and multiply by 15%. Now you divide that gross income. Let's say gross income of last year is 200 million of the bank. And then what you do is you divide 200 million into 8 business lines, which we are going to define right now. I will show you. I will show you the 8 business lines. Okay. Now, can you see the business lines? Can you see the business lines?
Yes, yes.
Okay. So basically, instead of taking the gross income for the whole bank, so the Basel defines the 8 business lines, which is indicated here. All of you can see the corporate finance, trading and sales, retail banking, commercial banking, payment and settlement, agency services, asset management, retail brokerage. So this is Basel given definitions for each business line. And instead of earlier 15%, now Basel says for each business line, you have a different alpha, we call beta factors. Okay. So now, for example, corporate finance, it's 18%. If you take retail banking, it's 12%. If you take agency services, it's 15%. So likewise, okay. So then what the Basel says, okay, then if the total bank's gross income is 200 million, for example, so identify how much came from the corporate finance. Let's say corporate finance have contributed 30 million out of the 200 million. So likewise, you take last 3 years of gross income from corporate finance. Okay, say last 3 years gross income from corporate finance, let's say 30 million, 20 million, 10 million. You take the average of that corporate finance gross income for the last 3 years, again positive figure, multiply by 18%. Multiply by 18%. Similar for other business line, trading and sales. Again, you take the gross income for the last 3 years from trading and sales business line, average it, multiply by 18%. Retail banking gross income for the last 3 years, average it, multiply by 12%. Commercial banking for the last 3 years gross income, average it, multiply by 15, and so on. And then you add all these 8 numbers, then you will arrive at the capital requirement for the total whole bank under the operation, for the operational risk. Clear? So that is what I have stated in my the previous slide. Okay. So capital chart for standardized approach equal summation of 1 to 3 years, gross income 1 to 8 into beta 1 to 8 divided by 3. Okay. Any questions? Anyone? Any more questions on that? Okay. So if you don't have question, final measurement method is the advanced measurement approach. Again, like the previous two risk, credit and market, again, this is again approach based on an internal model. Okay. So the bank is given freedom to use its own internal model to arrive at the capital charge for operational risk. But compared to the other two risk categories, credit and market, using a model for operational is a little bit cumbersome, because if you look at one of the important things, if you want to use a model, is what? What is the most important thing for any bank or anybody to use an internal model for whatever purpose? What is the most important thing? Anyone? Any guesses? Can anyone tell what is one of the most important things the bank should keep in mind? They want to build the internal model. Anybody? Most important element for building up a model is the bank need to estimate certain parameters built in the model. In order to estimate the parameters, what do you need? You need more data. Okay, so you must have sufficient data with respect to the parameters you are going to use in the model. If you don't have the relevant data, then it's very difficult for you to build up a model. Now, question with respect to the operational risk is, now if you look at the definition of operational risk, the risk events the bank would have experienced with respect to operational risk matters are very minimum compared to credit risk about the loans defaults. You have enough adequate data. Market risk about, again, the interest rate variation, foreign exchange variation, equity market variations, and resultant losses. You could have adequate data. But operational risk is the risk, the losses arising from the risk event due to failure of your internal system, external fraud, internal fraud, or calamity. Then the number of such events in a bank is very minimum compared to other two. So the data you would have had in history is very limited, unless you, even if you had some events, would have not captured them in a database. So that is the dangerous one. So that's why even Basel is not very preferable with this particular approach due to the limited time at the beginning. But the banks, if a particular bank has adequate data to build up a model, then definitely you can use this model with the approval of the regulator. Okay, clear? So, so basically, we know now that the three for the three different risks under the pillar 1, minimum capital requirement, the different approaches. The credit risk, we have 3 approaches: the standardized approach, IRB foundation approach, IRB advanced approach. Then for the market risk, again, standardized approach and the internal model space approach. Then for the operational risk, again, we have three measures: the basic indicator approach, the standardized approach, and the advanced measurement approach. So under Basel II minimum capital requirements framework, the bank has given an option subject to regulators' approval, the best methodology to be used in the respective banks. But in Sri Lanka, as I said, we are going by the most basic approaches. That is for credit risk, standardized approach, operational risk, basic indicator approach, and also for the market risk, standardized approach. Okay. Any questions before we move to the next slide? Okay. So that's pillar 1. Now we move on to pillar 2, which was not there in the Basel 1. So this came up with Basel 2. Now, can you remember last week I said, now objective of the pillar 1 is the regulatory capital. Objective of the pillar 1 we just discussed is the regulatory capital. So what is the objective of pillar 2? Can anyone remember? I explained. Objective of pillar 2, the supervisory review process. Can anyone remember?
To take into account the risks not fully taken or considered under pillar 1.
Yeah, so that's right. But what is the objective? What it measures, try to measures? The pillar 1 is the minimum regulatory capital. So what does pillar 2 do? Couple of words I need.
Under the pillar 2, the bank is trying to assign a capital for risk which are not addressed through the pillar 1.
So
and,
I want a particular word for that.
Assess the tier 2 capital.
Internal ICAP.
Capital is tier 1, tier 2 capital is captured in the Basel, regulatory capital pillar 1 as well. Here we are talking about the economic capital. The pillar 1 talks about the regulatory capital. The regulator says, okay, for these three categories of risk, you must have 4% core capital and 8% core capital. So as far as bank meets that requirement, you are fine. Say, if a particular bank has 8.1% of total capital, you are fine because you have met the regulatory capital. So there is no variation among banks in terms of regulatory capital. If you look at in Sri Lanka, all banks are required to meet only a particular amount. Now we are in the Basel III, so I will explain Basel III. So Basel III capital components are different. So let's say Basel II, under Basel II, all banks are need to meet 8%. That's it. Anybody meets 8%, fine. No issue of that. But Pillar 2 talks about the economic capital for entire risk bank base, which is not covered under Pillar 1. And even if it is covered, not fully covered under Pillar 1, which is very well known to the bank and based on the bank's business model. So bank very well knows, because if you look at, let's say, two banks, Bank of Ceylon and People's Bank. So regulatory capital say, okay, For the Bank of Ceylon, you must have total 8%. People's Bank total 8%. So let's say both have 8.1. Okay, in terms of regulatory capital, both are fine. They have met the minimum. But do the risk in those two are same? Does the business model of the two banks are same? No. Who knows about it? Okay, you, the bank. So that's why Pillar 2 talk about the more they talk about the internal risk, and the internal model of the bank should estimate what is the actual capital the bank need to cover the risk under Pillar 1 as well as all the other risks. Okay, all the other risks. Okay, now Pillar 2, can you see the Pillar 2, this slide please?
You can see.
Okay, so now if you look at Pillar 2, it's focused about mainly the interest rate risk in the banking book. Okay. If you look at Pillar 1, we didn't cover the interest rate risk in the banking book. Remember what we covered under Pillar 1? Market risk, Pillar 1?
Trading book.
Trading book. So here Pillar 2 covers the banking book as well. They should be supported by capital if significant. Now, if the banking book risk is significant, then you must support it by the capital. Apply standardized interest rate shocks. Okay, so you can apply any shock, general shocks. So banks with significant interest rate risk, okay, should reduce risk, increase capital or both. Okay. So if a particular bank have a significant interest rate risk exposure, not just the trading book, then you must either reduce risk, increase capital or both. Okay. So that is you bring in risk sensitivity into the capital charge. Then strategic risk. The risk to profitability arising from wrong assumptions about external environment. Okay. So the strategic risk, that is again an important element due to many factors. Your deviation from the external environment, economy, competitors, regulation. So you must bring in that. So which is not covered under Pillar 1. Okay. The capital provides a buffer until bank's business model can adapt. Stress testing planning assumptions. Again, based on stress testing, you may feel there's a possible strategic risk on your business model. Okay. Then another element is reputation risk. Okay, sorry. Another element is reputation risk. Okay, so then another element is operational risk. Okay. If you take reputation risk arises when there is a group contagion or when there are potential reputational consequences from another risk event. So if you feel your bank is subject to a reputation risk due to a group of the group in which you operated and its contagion, or due to risk arising from another event, for example, operational risk event, so you must factor that into your capital component. For example, is capital sufficient to cover the potential reputational consequences of a market, credit, or operational risk event? Again, you can do the stress testing. Then even the operational risk, whether the capital you compute based on the basic indicator standardized approach is sufficient. You must decide. So if not, then probably you may have a margin for that as well. Okay. Then credit concentration risk. So what is credit concentration risk? Now, you know credit risk. So what is meant by the credit risk? The failure of your borrowers to pay on time and on sum. Okay. But within the credit risk, there's a sub-element called credit concentration. Now, what do you mean by credit concentration? The single exposure or group of exposures that have potential to produce losses large enough to threaten bank solvency. Can anyone explain it? Now, for example, concentrations can be by borrower, can be by geography, industry segment, market segment, or product. Okay. So, can you give an example of a credit concentration risk? It's very simple.
So hypothetically, if a bank is exposed to, say, tourism of its of 50% of its portfolio, then it is subject to concentration risk, especially during this COVID pandemic.
Yeah. So, for example, if you overexpose to a particular area which is vulnerable, now, if you take tourism, now I'm taking an example from a Sri Lankan bank point of view. Now, from a Sri Lankan bank point of view, we know that tourism has been highly vulnerable sector for the past 30 years during the wartime, as well as now as a result of COVID. Okay. So, whenever a risk event take place, now classic example is COVID. Okay, I think all of you banks are running into problems due to moratoriums and all those stuff for these particular sectors. If a particular bank has overexposed, now the important thing is overexposed. Just because you have given loans to the tourism sector is not a problem now. The gentleman just now 50%. So if out of your total loan portfolio, 50% is for tourism, you are in deep, deep trouble. Okay, because you are highly concentrated. So you are not just facing the credit risk, you are facing the credit concentration risk. So that's why it's very important. You must diversify your portfolio by borrower, by geography, by industry segment, the market segment, and so on. Now take example, you are giving loans to, let's say, the export oriented, let's say the countries, like the countries which are having problems with rest of the world. So if you have given loans to those exporters who export their whatever the stuff to particular countries, and if there are some sanctions against those countries, then your exporters will find it difficult to get their money back. In turn, you will be in trouble. Okay, if you have more exposures, not just you are giving a loan. So if we have a broad concentration, so that's very important. So what the Basel says is look at credit concentration and have a margin for that. So you decide. It's not the regulator decide, you decide. So you very well know about your concentration. So banks should have internal systems, policies, and controls to identify, monitor, and control concentrations. Okay. So banks should include concentration considerations subject to periodic stress and the ICAPs. Okay. So some of the important points here are the bank management continues to have responsibility for ensuring that the bank has adequate capital to support its risk beyond the core minimum requirement. So bank management continues to have responsibility for ensuring that the bank has adequate capital to support its risk beyond the core minimum. So ensure you have a responsibility to have a capital more than the minimum. You can't just run by the bare minimum. Okay. So the minimum is, let's say, 8%. So you can't be happy if you meet that. Let's say the regulator say you need total 8% capital. In your bank, you have 8.1. So can you be happy with that? Can you be happy with that? Hmm? Can you be happy? Say the regulatory capital is 8%, your bank has 8.1. Can you be happy with that? Anyone?
Not necessarily.
Okay. You may not be happy because if there are other risks which I mentioned, which needs more capital, as per your estimate, then you must have more than that capital. Okay. So that is very well known to you. So you must estimate the right capital you require based on your internal risk, not just the risk captured under pillar 1, and also you are based on your future business model and the strategic plan. So you can't satisfy just because you are having minimum 8% capital. Okay. So the bank management continues to have responsibility for ensuring that the bank has adequate capital to support its risk beyond the core minimum requirement. The supervisors are expected to evaluate how well banks are assessing their capital needs relative to their risks and to intervene where necessary. Okay. Now there is a role for the bank and also for the supervisors. The supervisors must evaluate how well the banks are estimating their capital need based on to risk and to intervene where necessary. So the capital should not be regarded as a substitute for addressing inadequate risk management process or controls. Okay. So under pillar 2, the Basel talks about 4 principles: bank's own assessment of capital adequacy, supervisory review process, capital above regulatory minimum, the supervisory intervention. So the whole pillar 2 is based on these 4 principles: the bank's own assessment of capital adequacy, the supervisory review process, the capital above regulatory minimum, and the supervisory intervention. So let's look at one by one. So bank's own assessment of capital adequacy. Okay, bank's own assessment of capital adequacy. So that is the principal one. What does it say? The bank should have process for assessing their overall capital adequacy in relation to their risk profile and a strategy for maintaining their capital levels. Okay. Bank should have a process for assessing their overall capital adequacy in relation to their risk profile and a strategy for maintaining their capital levels. Okay. So that is the principal one. Okay. So how they do it? So they should tailor bank activities and the risk involved in these activities. So how that assessment could be done, bank's own assessment of capital asset, tailored to the bank's activities and the risk involved in these activities. So that's why I say even any bank need to comply with the regulatory capital minimum fixed amount Each bank's activities are different, risks are different, risk sensitivities are different, so that under pillar 2, you must tailor into your activities and risk involved to assess the capital adequacy. And the second thing is there is no best practice with regard to design and implementation. No one size fits all. So it is different from one bank to another. You can't say, you know, there is a model for that. No best practice. So you, as a banker, as board of directors, as KMPs, you must estimate what is the right amount of capital they require for me. Okay. However, there are some key features that should be included in every bank's ICAP, which we are going to discuss in the next slide. So what is meant by ICAP? Okay. Okay. Let's look at ICAP. Now, under the pillar 2, the first principle, so bank has to do a own assessment of its capital beyond the regulatory capital. So in order to do that, they have to prepare a ICAP, internal capital adequacy assessment process. Okay. Internal capital adequacy assessment process. Can you see it? Okay. Now, in a capital adequacy assessment process is a report prepared by the bank for the regulator's approval. So here, in summary, what it does is bank look at different components of its risk and the capital and the governance structures and the capital management processes and prepare a report stating, based on my internal assessment, I need this much of capital. Or I am sufficient with this much of capital. And when it is submitted to the regulator, the central banks assess it to ensure that is a valid assessment, or that is something regulators can accept. Regulators can accept comfortably, so that bank has sufficient capital beyond the regulatory capital against its assessed risk. Okay. So when the bank prepares this report on its own risk assessment, the regulator must be satisfied with that assessment. So let's say, based on the assessment, regulator feels the bank needs more capital. What the regulator does is the regulator sets a buffer above the minimum capital requirement. So regulators say, okay, look Bank of Ceylon, look HNB, look ABC Bank. Okay, I wanted you 8% minimum regulatory capital, but based on your ICAP, that is not sufficient. So you must maintain at least 11%. You must maintain at least 11%. You can't continue like other banks. So it is something the regulators decide based on your ICAP. Clear? So let's look at in ICAP, what are the broad areas ICAP would cover. The report, ICAP report would cover. It carries the executive summary of the purpose, scope of the assessment, the main findings, the material risk, the capital outcome, the governance structures, process, challenge and attestation, the future plan. So it's a broad summary of rest of the areas of the risk assessment. Then the second element is the business background. So here the bank must give a full picture about its business background, the group structure and the governance, including interface with the parent, the risk implications, the key business activities of the bank, the financial summaries, business strategies, operation plan, the key business assumptions, because all the risk components and the risk assessment and the capital requirement based on your business strategy and the operating plan. So that may be different from one bank to another bank. And also the key business assumptions, whether the assumptions you make are material and acceptable. Then the third part of the report covers the current and projected financials. So this is again an important element to assess your risk levels and then whether your capital is sufficient. The present financials such as profit and loss and the balance sheets, the projected for the next 3 years, for example, or next 5 years. So projected financials, the expected business trends and operating environment. So what could this, because now all this capital we compute today is for the, not for today's requirement, for the future. Today we know the risk, we know the balance sheet. So we know our capital, we know exactly whether we are short or excess. But what is important is to face the future risks. Are we comfortable now? Whether we have adequate capital. If not, we must add new capital. So expected business trends and operating environment, capital generation and capital returns. So that is about that part. Then fourth component of the report covers the material risk and assessment. The risk framework, governance and coverage, defining population and materiality thresholds, determination and mapping of material risk profiles, mitigation of material risk, systems and controls, capital and combination of two. So basically, it covers the entire risk assessment of the bank, giving the full picture of the material risk and the systems and controls and the capital in place or the required capital to cover up the risk. Okay. Then the next component of the report is aggregation of risks and capital. So there it tries to align the risk with the capital. So what are the material risks? The capital assumptions for material risk and in aggregate. Okay. So how those two can link? Are we adequately capitalized in terms of risk? So assumptions regarding diversification and so on. So these are typical key elements I have highlighted. Then the next part of the report is capital management approach. So if a particular bank feels the capital does not cover, or you need more capital to cover potential risk you estimated previously, you must have a framework to manage capital. So how we are going to bring in capital to manage risk? So it's basically capital management framework, capital planning, and etc. And the next component is key sensitivities and future scenarios. Okay. It's a more or less again futuristic risk analysis. The key sensitivities and future possible scenarios, and then based on that, are you comfortable or do you need more capital? So at least for 3 years, key assumptions underpinning base case, stress and scenarios. Okay, so different stress scenarios, base case stressed, contributors to future net stress capital requirements, and so on. Okay, so basically it's about more or less scenario analysis, stress testing for future scenarios which could pose significant risk to the bank, and to arrive at an assessment of capital. Then the next component of the report covers the governance framework. How your ICAP program is governed within the bank. So it basically covers integration of risk, capital management, and business strategic plan. Capital allocation. Okay. Management information systems reporting. Okay. Nature and frequency. So basically, so these are the components which should be covered under ICAP report. Okay, clear? So what it tries to do is you do your own assessment and you prepare this report and you submit to the regulator. And if the regulator is satisfied with that and you satisfied that you need more capital than the minimum regulatory capital, you must go for that. If the regulator is not satisfied, regulator may impose additional capital top of the regulatory capital. So this may be different from one bank to another bank. Now let's say ABC Bank, the regulator say ABC Bank, hello ABC Bank, I know your minimum regulatory capital we have set is 8%, but based on your ICAP analysis, you are at a higher risk level, you need additional 3%. So you must have 11%. Then you can't say, no, the other bank need only 8% or 9%, why I should have 11%? You can't say that. It's based on your own risk analysis. Whereas the other bank may have a less problems and he may be, it may be still can run with a lower capital. Okay, so that's the important part. So in doing so, you must cover many more risks above the risk covered in the Pillar 1. So credit, market, operational, interest rate risk in the banking book, liquidity risk, model risk, business strategic and reputational risk. So all the risk, basically in ICAP report, it covers all the key risks a bank would face, including credit, market, operational, and many others, including even model risk, the risk arising from the wrong model. Okay, so you must, if you estimate, then you must build that into your models. ICAP should explain the process by way of policies, procedures, systems, controls, and personnel for identifying, measuring, managing, and reporting risk on a continuous basis. Okay, so this is not something you do once, but you must continually follow up and also report on a continuous basis. So you can't just sleep once you prepare the ICAP report. You must continue it. Okay. So then look at what other factors bank management should consider in determining target capital levels. I have highlighted few factors. These are not the only factors, but few factors. Regulatory ratios and requirements. So look at regulatory ratios and requirements. That is more important. Peer comparisons. Look at how, what do you mean by peer? Can anyone tell what is a peer? Okay, what is meant by a peer? Anyone?
Companies in the same level.
Okay. Now, if you take peer, a bank, another bank with similar operations, with more or less similar risk and similar size and so on, compared to your bank. So you can have a look at how, I am in par with this particular bank or the group of banks. So how am I faring in terms of my capital compared to those banks? So that gives some comfort whether you need more capital or you are running with excess capital. So this is again one way of looking at it. The expectations of shareholders, counterparties, and rating agencies. Again, now if you look at shareholders, they may expect dividend from your bank. Why a person would invest or entity would invest in a particular bank is expecting a return, a dividend. So you must have sufficient, if you want to fulfill that requirements, you must have sufficient internal capital built up or internal profits built up. The counterparties look at your stability in doing transactions with, let's say, foreign entities, foreign banks, the rating agencies for their risk assessments, the concentration of credit and other risks, again concentrations, how excessively concentrated a particular bank, the business cycle effects, the effects arising from business cycles, ups and downs in the business cycle. In a recession period, you may have more problems compared to the expansion period. So, sorry, you can do a forward-looking stress test to estimate the particular risk. The formal modeling and risk analysis. So you can do modeling, other qualitative and subjective factors. So you must look at many more aspects before arriving at the right capital level for you. So let's look at stress testing. So what do you mean by stress test? As I mentioned in the previous slide, so banks should include stress test as part of their ICAPs. So what is a stress test? Anyone can explain? What is a stress test? Anyone?
You pressure certain areas of the organization and business aspects and see what kind of measure you need to absorb that kind of a risk.
Can you give a little bit example of that? What you do, I think all of your banks do stress testing. Your colleagues or you would have experienced this. A very simple example of a stress test. Or you experienced during your bank or even you heard from anybody.
Fire drill?
Huh? Sorry?
Can we consider fire drill type of a stress testing?
It's not a stress testing, no. Fire drill is something, what is it like, what do you call, it's like recovery plan or something like that, Very simple example, I think. Anyone can give a very simple example.
If the default risk of the particular segment is increased by a certain percentage, what would be impact on my capital?
But okay, can you elaborate it a little bit?
For example, let's say we have given an advance to the tourism sector, already it is affected, but we suppose if that sector is not performing for a period of 1 year or 2 years, within which what is the impact on my capital based on that?
Okay, so I think you are right to a certain extent. So basically you stress, for example, now the example you took, tourism sector, okay. Now, due to their inability to operate over the next 2 years, what would be my NPLs? Okay, what is the impact on my NPLs? NPLs would rise. Okay, if NPLs rise, then that will be a hit on my balance sheet. and then capital. So it's a stress test. You assume a thing, but which may not happen. You assume if this is going to happen, my NPL will rise to 10% from 5%, then what is the impact? So you assume things and do analysis and see whether you can manage it. That's the important part. And also try to estimate the possibility of that particular thing here. Not necessarily tourism sector, but for even for other businesses which run, satisfactory. You can do a stress test, not just because of that particular sector is doing bad. Let's say due to whatever reason. Now, for example, assume that you assume interest rate will, based on the current fundamentals, interest rate will go up by 3-4% next 1 year, 2 years. And do a stress test and what is the impact on your trading portfolios. So like so on. So it's a futuristic, you assume a futuristic scenario. If it happens, what would be the impact and whether I am capable of meeting such an impact based on probability of that particular event is happening. Okay. Then the results of the stress tests can be used to challenge the risk appetite. The risk appetite means the tolerance. Okay. They adjust the strategy. So you can adjust the business strategy. So if you feel there are significant risks that could emanate as a result of potential possible future events on certain areas of your business, so you can change business strategy in respect to those areas. So for example, you have planned that, or you have planned that you will aggressively grow into tourism sector, but now you can change the strategy looking at the risk. Okay, so likewise for any other business operator, you can set limits. Okay, if you feel particular areas should be minimized, you can set limits. Okay, you can adjust controls. You can have more controls in place, or you can reduce controls in certain areas while increasing controls in other areas, so that you can allocate resources effectively. Develop capital management and funding plan. So you can change your capital management and funding plan and targets based on the stress test results. Then capital planning. So the capital planning is a roadmap for bringing value while anticipating and adapting to change. Okay, so it's a process where you plan your future capital based on potential risk elements, based on many aspects. So basically, capital planning process should outline the target capital levels given the bank's risk profile, risk appetite, and regulatory capital requirements. Okay, so it may be different from one bank to another bank because of the different risk appetite, because the appetite of different banks may be different. Okay, and also the regulatory capital requirements. Then a strategy for ensuring adequate capital is maintained. So you must build up a strategy now to cover up against this. You must have, you have capital in place. The capital buffers, triggers, and actions to avoid rectify breaches. Due to particular raise, if your capital is going to fall below even regulatory minimum, then you must have buffers to cover up, and also actions to rectify those breaches. The capital management process, how we are going to manage capital in the future, because you can't raise capital immediately in a crisis. It's very difficult and it's very costly. External capital and funding sources. So you must have a plan to identify from where you are going to raise capital. Okay, or where you want to borrow. So you must have a framework. Okay, from which parties are you going to? For example, are you going for a new capital issue? Are you going to a right issue? Are you going to borrow from other parties internally or foreign? So you must have built into that. expected capital requirements. So based on that, you must target how much capital you need. Then process for reporting to the board and senior management. So there should be a process for reporting to board and senior management. So again, the important element is the communication about your capital planning, the risk to the board and senior management. So there should be a process about the risk exposures, the regulatory capital requirements, the capital levels relative to targets, requirements, earning forecast, other forward-looking considerations, threats, challenges, and uncertainties. So it's basically how you must report to the senior management. There's a framework, maybe from the risk unit, about the risk exposures, the regulatory capital requirement, then what is your capital level compared to the target, and the potential earnings forecast for the future, and other potential risks, threats, challenges, and uncertainties in the future, and how you are going to manage it. The importance of monitoring, reporting, and review of risk and capital, including ongoing compliance with regulatory capital requirements. Again, important of monitoring, reporting, and review of risk and capital, including ongoing compliance with regulatory capital requirements and capital targets. Again, important. Ongoing review of ICAP. Again, now once you prepare ICAP, you must review at least every 3 years. Okay, because the risk profiles, the threats, challenges, and uncertainties you forecast 3 years ago would have changed by that time after 3 years. So you must review what are the new things that have come in, what things moved away, and what new threats, challenges, and uncertainties in next couple of years, so that you must change your plan. So it's good to review your ICAP every 3 years. Then you can submit new ICAP to the regulators. So that's broadly the components under the first principle, the bank's own assessment of capital. So what is expected from the bank is to do a own assessment of capital, prepare ICAP report, consider all these factors I mentioned in preparing ICAP report, submit to the regulator, get it approved or get it assessed by them and approved it, so that you know where you stand and you are comfortable enough to face any risk arising in the future against not just the risk covered under minimum capital requirement pillar 1, for any other risk which could emanate in the future. So it gives some comfort to you now. You are ready to face any challenges. You are ready with adequate capital so that you can sustain the regulatory capital if there are significant risk events in the future. So it's like something like this. Now, I mean, outside this scope example, now, for example, when you get into the highway, you are required to comply with some requirements, regulatory requirements. If you're getting into a highway, what is the regulatory requirement you need to comply? Can anyone tell? If you're getting into you move into a highway in your vehicle, there is a typical regulatory requirement, like our capital requirement. So what is it? Hope anyone you have gone in highway. What is the regulatory requirement? No one has traveled in the Sri Lankan highway or even foreign highway. No one has gone.
Keep into the correct
Huh?
line. Keep into the correct line. Yeah, going.
There is no specific requirement like that. It's some guideline, but a specific requirement is there. I'm asking a particular requirement.
Speed limit.
Speed limit, yes. So a specific requirement of a speed limit. So what is the limit in Sri Lankan highway? What is the limit?
It varies from highway to highway.
Yeah, but generally, I don't think we have many more highways. But in Sri Lanka, what is the max limit?
100.
Okay. I think you must travel in highway. I think most of you took more than 2-3 minutes to tell that. So try highway drive and see what is the limit. Everywhere it is said maximum limit is 100. Okay, certain areas may be a little less. So that is something regulatory. So whoever the authority has sets a limit, you must not drive above 100 kilometers per hour speed. It's like our Basel minimum. You must have minimum 10% of total capital or 8% of total capital. So that's who sets that? The regulator. The central bank says your capital, total capital should be minimum 10%. Okay. Now here say you can't exceed 100. So what does it mean? Can all of us, let's say there are 5 guys traveling in different cars, okay, on the highway, can all these 5 guys can drive at 100? Can all these 5 guys with 5 different vehicles can drive at 100?
No, sir. It would depend on the vehicle and the driver's driving ability.
Yeah. So we have given option to go up to 100, but not all 5 can drive at 100. But that depends on the vehicle condition. If you look at vehicle, there are many aspects. Brake condition, tire condition, and many other aspects. And also driver's ability. Again, the person who drives, how comfortable, how experienced, how his ability to take risk, unexpected event. Okay. External factors, the rain, wind, nature of the, like if you do foreign country, the snow conditions. I mean, the same driver, same vehicle cannot move at the same speed in a normal day and a rainy day because external conditions are pretty bad. So even though the regulator allows to go at 100 level, you must decide, okay, what is the right speed for me? Because I know weather is bad today. I know my tires are not good. I know my brakes are not good. I know I just got my license, so I must not go with the same speed like somebody else going because I have given option to go at 100. So I must do my own risk assessment. Now here risk assessment means my vehicle condition, my capacity, my tolerance level, external conditions, how can bear up if there is something goes wrong without meeting accident. So I will select, okay, I will not go at 100, I will go at 70. So that is something I have to decide based on my risk analysis. Not somebody else can't tell. The police can't tell, okay. Police has given option, okay, 100 is the max. If you wish, you can go with up to 100. You are not violating the law. But if you exceed the 100, we will punish you. As far as you are below 100, we will not punish you. But this does not mean everybody, every one of us, the 5 guys can go at 100. So same here, capital. I just brought in that example. You must have minimum 8. It doesn't mean if you have bare minimum 8, you are comfortable. You can't compare with your peer. You can't compare with another bank because I have 8% minimum, but when I looked at my risk, my own assessment of risk, I am not sufficient with capital with 8%. So I need at least 10%. So I estimate based on my own risk assessment, okay, regulator says 8%, but I am safe if I have 10%. So you should decide what is the right capital level for you. So that's the beauty of the pillar 2. So pillar 2 is going beyond pillar 1, minimum capital requirement, and estimate what is the right capital to you. Like highway. So we are not going to drive at 100. Now take a rainy day. Even the same vehicle, same driver will adopt a different strategy because the risk is different. There's an external threat coming. So threat, challenges, and uncertainties. Okay, I think you saw last week happened in a highway in US, almost hundreds of vehicles met with an accident due to the slippery conditions, due to the very bad snow conditions. You would have seen hundreds of vehicles met with an accident, you see, because probably due to negligence or maybe unexpected external conditions. So you must adopt the right strategy. Okay. So the pillar 1 is minimum regulatory capital. Pillar 2 talks about economic capital above the minimum regulatory capital based on 4 principles. The first principle we just looked at is your own assessment of capital. Any questions? Then we have to move to next principle, probably after a short break. Anything more to clarify on principle 1? Okay. So if you don't have questions, we'll start fresh after a small break.
So, excuse me, sir. If the ICAP review process should be done every 3 years, why the banks do it annually?
No, it's up to you. You can review annually because it is better if you can do it annually. No, this says at least 3 years. I said at least 3 years because it's better that you do it. I mean, if you can do it annually, that's fine. If the environment in which you operate is little bit volatile, better you do it annually. More frequent is better. More frequent is better. Okay. So at least 3 years. It's an example, ongoing review. But it's because now this is a more broad assessment, no? So more broad assessment means generally broad aspects will not change at short intervals. I mean, your strategies will not change every year. You adopt a strategy. Now, if you look at a strategic plan in your bank, at least it covers about 3-year plan. I think all of your banks would have strategic plans. It covers a minimum 3 years. Some strategic plans even covers 5 years. So broad policies will not change at very short intervals. So that's why in general 3 years, it's a good opportunity to review but no harm in doing annually. Exactly, it is much better. There's no harm. especially under a volatile environment. But generally, 3 years would be, I don't know, I can't remember whether there is any new requirement by the central bank stating you must do it every year, but I can't tell any answer to that, but I will check. But it's better that if you could do it, there is no harm in it. Based on the environment, it is more comfortable. You are more comfortable doing every year, so that you can face any risk or threat without any problems. There is no harm. But I will check whether any regulatory requirement of doing it every year now. Any questions? Any more questions? Okay, if not, it's almost 10:30, so we'll again meet around 20 minutes time and move on to the second principle. Okay, so we'll stop for the moment. We'll start maybe around 20 minutes time. Shall we start? Everybody is here?
Sir, regarding the question I asked about the ICAP document, there's this regulation which says that there should be a board-approved annual document of ICAP, which we should annually submit to the DBS.
I couldn't hear you. What is that?
There's a direction which says that we have to annually submit a ICAP document to the DBS.
Okay. This is a new direction?
Oh, no, this is issued in 2013.
2000?
2013 direction number 5.
Okay. 2013?
Yeah, this is the annexure to that for Basel 2, Pillar 2 regulatory framework on supervisory review process.
Okay, okay. Yeah, so generally the 3 years, but if the regulator, says anything additional, that's the banks need to comply with that, or probably, as you said, if there is a requirement, then of course you have to comply with that. But I mean, at least 3 years would be ideal, because plans would fit in medium-term, target. So, but of course, if a regulator says annually, you are supposed to review it annually, so that's okay.
Okay.
Any more questions, clarifications? Okay, shall we move on to the our slides presentation? Can you all see? Can you see?
Yes.
Okay. We discussed the first principle of the supervisory review process, that is bank's own assessment of capital. Now we move on to the second principle, process of supervisory review. Now the second principle says supervisor should review and evaluate banks' internal capital adequacy assessments and strategies, as well as banks' ability to monitor and ensure their compliance with regulatory capital ratios. So now the first part is the responsibility of the bank's management. Okay, so the doing own assessment of capital is something banks need to do. Now the second principle says, okay, once bank does it, it is the responsibility of the banks, the supervisors or the regulators, the central banks to evaluate banks' internal capital adequacy assessments and strategies, as well as banks' ability to monitor and ensure their compliance with regulatory capital requirements. So, the second principle, the responsibility lies with the regulators, the supervisors, or the central banks. So now in that case, the important thing for the supervisors must have adequate tools to do that. Okay, whether the banks have done a good job in terms of the first principle, so that probably they will use the different tools, the on-site examinations, the off-site surveillance, the periodic reporting, the review of work done by internal and external auditors, the meetings with bank management, the review of banks' other information, reports, board papers, etc., to see whether bank has done a proper job or whether they are satisfied with the internal capital adequacy process. Then probably the areas of supervisory review will cover the board and senior management oversight, how the board and senior management looks this aspect, the systematic capital assessment and planning, the assessment of capital planning, how it has been done, the comprehensive risk management on the area of risk assessment, how comprehensively bank has done, the stress testing, okay, the monitoring and reporting. So these are the broader areas supervisor will look at with respect to your assessment, your board and senior management oversight, the systematic capital assessment and planning, the comprehensive risk assessment, stress test, monitoring and report. So in the review of in the supervisory review process, they will look at these broader areas. Okay. So let's move on to the third principle. The third principle says the capital above regulatory minimum. Okay. So again, like our US speed limit. Okay. You must not go up to that level. You must have a buffer. So the third principle says supervisors should expect banks to operate above the minimum regulatory capital ratios and should have the ability to require banks to hold capital in excess of the minimum. So supervisors expect, even though the regulatory capital requirement is set at a particular level, the banks operate above the minimum at a comfortable level. For example, regulatory minimum capital is 8%, but the supervisors expect don't just maintain 8%, have a sufficient buffer above the minimum, so capital above the minimum ratios. I think we discussed this again in detail, but let's look more formal reasons why should banks operate with an additional capital buffer. We earlier looked at the economic capital is an element of potential risk within a bank arising from unexpected events in the future, as well as its business model and the external environment. In general, why a bank should operate with an additional capital buffer, just not the minimum? The competitive reasons. The banks in a very competitive market, so they are, market share may go up and down, and probability may result in different risks. As a result, the profitability and other aspects could be impacted negatively, so that it is better to have an additional capital. The fluctuations in overall capital ratio occur in the normal course of business. Now, for example, if you look at a bank, every moment a deposit is coming, a loan is granted. So every moment, or maybe investment is made. So every moment, the structure of the bank balance sheet change every single minute. Okay, every single moment. So whenever the structure changes, what happens? Whenever structure changes, every minute, what happens? Or what the bank should do? So what happens, or what the bank should do? Anyone?
Based on the new risk-weighted asset, they have to keep the capital.
Yeah, so in other words, every moment the capital adequacy ratio changes. Okay. Basically, every moment capital adequacy ratio changes. So if you don't have sufficient buffer, what happens? Definitely, every moment, sometimes your capital adequacy ratio may go below the minimum requirement. Now, for example, let's say your bank is running with a bare minimum regulatory requirement without a buffer. So you are maintaining exactly, let's say 10%. So your requirement is 10%. So you are maintaining 10%. Exactly. So basically, in terms of regulatory capital, you are fine. You are compliant. Now, let's say there's a good customer comes, for a loan of, let's say, 500 million. Okay, 500 million, and you feel the loan can be granted. Okay, but that is unsecured loan. Based on the credit rating, what happened? You need to keep, let's say, 50% risk weight. Okay, 50% risk weight. Okay, so likewise, couple of customers comes and you feel that you can give the loan without any problem. So let's say your risk-weighted asset as a result of these new customers, loans to be given to new risk customers, increased by 1,000 million. So what happens? What happens if you are to give a loans to these customers? What happens? So let's say your existing risk-weighted assets is 10 million. Okay, 10 million. Your 10 million. Your capital is 1 million. So basically, you are meeting the 10% requirement. Then new 1 million loan, let's say 1 million, additional 1 million loans are required, and your assessment says these are comfortable loans. But what happens if you are to grant these loans? What happens?
You have to raise an additional capital of 1 million if the risk is 100%.
1 million? No.
Sorry.
So basically,
16%.
what happens before that? What happens if you are to given these loans? If you are going to give this loan, what happens first? Let's say you decide to give this loan. So your risk-weighted assets increase from 10 million to 11 million. But your capital is 1 million. Your capital adequacy ratio fall below 10%. Okay, so that's the first thing happened. Then what happened? You are non-compliant. Okay, so in order to comply, you need to raise capital. But can you raise capital immediately? In order to give the loan, can you raise capital immediately? Practical sense. Whenever you want to give a loan, can you raise your capital immediately? Very simple question I'm asking you.
You
No,
can't.
it takes time.
Huh? Can you raise your capital immediately?
Immediately you can't.
Huh?
Immediately, we are unable to raise.
I can't hear you properly.
Immediately, we can't.
Yeah, not even immediately, even short term you can't. You can't raise capital within maybe day, month, 3 months, 4 months. Capital raising is a time process or time consuming event. So what will happen? So what is the best scenario you could do? If you can't do it, what is the best scenario?
Keep in the additional capital.
Huh?
Keep in the
So
additional
you don't have
capital.
capital. I said you are running with 10%. What is the best scenario you can do now?
You can't grant the loan.
Huh?
You can't grant the loan.
You can't grant the loan. So 2, 3 good loans, you can't grant the loan. That's the best thing you can do. Because if you do, your capital ratio will come below. There is no way of that raising capital or doing anything. So best thing is to avoid giving these loans. Okay. So what does it mean? You lose your business. So can you tell the customers, okay, dear, I have only limited capital. Can you come to me after 3 months? Can you say that? You are very good customers. I want to give you the loan, but my capital adequacy ratio is not enough to give you. Please come and meet me in 3 months or 6 months. Can you tell that? Huh? You can't tell. You can tell, but the customer will tell you go to hell. I will go to bank B and get the loan. Huh? You mind your own capital requirement, but I want a loan immediately. So why is that happen? Because you are running with the bare minimum. So that is why you need a buffer, because you can't you can't bring in capital, or you can adjust many things very short intervals. So if you have sufficient capital, you can maintain the fluctuations within the minimum level. Okay. So again, the third point very well says cost of a bank to raise capital, especially when needed quickly or when market conditions are unfavorable. It's very difficult. Let's say these things happen in a difficult period, raising capital even short time is difficult. I mean, anyway, raising capital within 1 month, 2 months is not possible. But even if you can do it within, let's say, 3 months, if the market conditions are not good, then it's again difficult. Okay, now if you look at present market condition, can a bank raise capital easily? Maybe a little bit difficult. Okay. The next point is bank-specific risks or macroeconomic factors may not be taken into Pillar 1. Now, the Pillar 1 does not take into account the macroeconomic factors or bank-specific risks. It's a general requirement. Okay, so that's why it is important under the Principle 3, you need to maintain capital above the minimum requirement. Okay. Let's move on to the fourth and the last principle under Pillar 2. So it says the supervisor intervention. The supervisor should seek to intervene at an early stage to prevent capital from falling below the minimum levels required to support the risk characteristics of a particular bank, and should require rapid remedial action if capital is not maintained or restored. So this is again, now this principle is a task given to the supervisors, the regulators, central banks. So whenever they see capital levels of a bank falling, okay, below the minimum levels, okay, so when they feel capital will be coming down and will further erode below the minimum level, immediately they should intervene at an early stage. I mean, you can't do anything once you reach the bare minimum, but when you see during few months, few weeks, or gradually capital is coming down from the levels it had, so definitely you have to intervene and require the banks to ensure capital is restored, or take remedial action to ensure the capital will not fall below the minimum. So the potential supervisor actions include increased monitoring, requiring the bank to improve the ICAP. Okay, so if the regulator feels the present ICAM is not sufficient to meet such a requirement, such a decline, so regulator can ask the bank to improve the ICAP, requiring the bank to submit a capital restoration plan. Requiring the bank to submit a capital restoration plan. So that is asking the bank to submit a plan to infuse capital to avoid further losses, placing restrictions on bank activities, acquisitions, etc. So place restrictions on bank activities, acquisitions, etc. Restricting the payment on payment of dividends in excess of the capital conservation buffer, so that regulator can say, okay, any activity which will further deplete the capital should be stopped. Now, for example, dividend. Okay, don't pay dividend, conserve the dividend. Instead of dividend, conserve the reserves. Don't pay dividend. Or restrict the bank activities. Now, don't spend on branch expansions, acquisitions, because you can't spend on those when you see that your capital is falling. To avoid further depletion, you can restrict certain activities until such time the new capital is brought in. And also, even if the regulators feel the boards and senior management have been inefficient, or they have not done a good job and are not capable of doing that, even they can ask the replacement for board or the senior management. So those are the potential supervisory actions the regulator can take to ensure the capital will not fall below the bare minimum. Any questions? So that's broadly the key features of Pillar 2. Any questions before we move on to the, I will come back to the Pillar 3 towards the latter part of the next part. So basically now we have covered Pillar 1 and Pillar 2. And I will come back to Pillar 3 later. Any questions before we move on to Basel 3? Okay. So if you don't have any more questions, let's move on to the Basel 3. Okay. Now, even though Basel 2 came into effect in 2004, in fact, really practiced around 2006, soon before it got implemented, internationally, globally, there was a significant financial crisis. So if you all know, in 2008, 2007, late 2007, 8, 9, the many banks around the world were subject to a financial crisis. So that resulted many international banks facing or even failing due to the crisis, which emanated as a subprime crisis. All of you know that the crisis emanated from some US banks, US mortgage banks, the loans granted by US mortgage banks to the mortgage purposes, especially housing and the real estate. So as a result of the the recessions in the economy, which emanated to the financial sector, resulted in these the customers of second-tier banks, mortgage banks failing, and then as a result of these mortgage banks failing, then the banks, the commercial banks, which lended to these mortgage banks, facing problems and even running into liquidity issues. So some banks failed, some banks revived. Globally, especially US, even in like Greece, Europe, certain countries, significant problems, UK. So it was a significant crisis which led many banks, many financial institutions running into problems. So the questions arose, despite Basel II just enacted and started implementation, how this could happen. The main issue is this Basel I and II, the capital requirement was focused to support the normal risk arising in a bank. Normal risk arising in a bank under normal circumstances. In the general day-to-day business, to cover up against these risks, Basel suggested these capital requirement under 1 and 2. But if you look at a crisis like what happened in 2007, it is a significantly stressed scenario. It's not a normal stress. Significantly unexpected stress scenario. Like COVID. Now, COVID is something unexpected. So in such a case, the regulatory capital set down under the Basel II was not enough to safeguard the banks. Okay. So if there is a significant stress event, it's not easy for a bank to have capital in the form of what we discussed under Basel II. So you need more capital than what is set in the Basel II. Okay. So the critical questions which came into the minds of the committee, Basel committee, the quality of regulatory capital appeared often insufficient to absorb bank losses effectively. Okay. So the regulatory capital was not sufficient to absorb losses of the banks effectively. The quality of the regulatory capital. Inadequate capital to capture risks arising from banks' exposure to transactions such as securitizations, derivatives, and repurchase agreements, or take into account systemic risk associated with increase of leverage in the financial system. Now, systemic risk is risk not just for one bank, to the entire sector. Now, if you look at Basel II elements, basically it covers individually. The individual bank, if you have these risks, this much you should need. But in a systemic crisis, everybody is affected. So in such a scenario, it's not sufficient. The third important point is, did not have any internationally accepted quantitative standards for liquidity. So until Basel III came into effect, there was no standard for ensure the liquidity. Remember, even Basel II only credit, market and operational risk covered. Pillar 2 partially covers economic capital, but not a standard. So that depends on your own risk assessment. Okay. So that's why Basel III introduced two liquidity ratios, which we discussed under liquidity risk. Remember, a couple of weeks ago, we discussed liquidity risk. Remember, what are the two ratios we discussed, which came along with the, or which introduced under the Basel III for liquidity? Can you remember?
LCR and net stable funding ratio.
Yeah, LCR, liquidity coverage ratio, and net stable funding ratio in the SFR. So the third point is that, but that we have discussed separately under the liquidity, so we are not going to touch again. So objectives of Basel III. to strengthen global capital and liquidity regulations with the goal of promoting a more resilient banking sector, to improve banking sector's ability to absorb shocks arising from financial and economic stress, which in turn would reduce the risk of a spillover from the financial sector to the real economy. Now, here our broad focus is not just the individual bank-specific risk, but a stress or shock arising from financial and economic stress. Shock arising from financial and economic stress, starting from financial sector, moving to the real economy. So, under the capital reforms, the key aspects the Basel III considered the quality, the consistency, and transparency of capital base, capturing of all risks, controlling leverage, and the buffers. So I discussed the liquidity side, but here the capital side, the important aspects the Basel III looked into: quality of the capital, consistency and transparency of the capital base. So when you look at further, the capital structure was further enhanced from the quality aspects. We will look all those things in a little while. Capturing all risk, the leverage. Now, again, if you look at a new measure called leverage ratio was brought in against the leverage factor, because leverage is the key risk in a bank. They are highly leveraged. Debt to capital ratio is fairly high compared to a normal business entity. Then buffers. There are two additional buffers introduced under the Basel III, which we'll look at shortly. Okay. Now, under the Basel I and II, we had two key capital components. What are the two capital components we had? The Tier 1 capital or the core capital, the Tier 2 capital or the supplementary capital. Then those two combined, after adjustments, you end up with the total capital. Now, under Basel III, the Tier 1 capital, which is the core capital, is further divided into two components: the common equity Tier 1 capital and additional Tier 1 capital. Okay. So it's a subdivision of Tier 1 capital based on the quality of the capital. So based on the quality of the capital, it is further subdivided into two: common equity Tier 1 capital and additional Tier 1 capital. Then you have Tier 2 capital. So basically, Tier 1 capital is the solid, strong capital, which is known as the going concern capital. The Tier 2 capital is going concern capital. You can use it at a going concern situation. So what are the limits? So let's look at the limits. Okay. Now Basel III says, no, I am here talking about the international standard, but I will come to the Sri Lankan context little later. Now internationally, when Basel III was introduced, the committee said internationally there must be common equity Tier 1 capital of at least 4.5% of the risk-weighted assets at all times. The Tier 1 capital must be at least 6%. And the total capital must be at least 8%. So what is the difference you see from the Basel I and II to the Basel III? What are the significant changes? You see, What are the significant changes? In terms of numbers? From Basel 2 to Basel 3, capital requirements. What are the most significant change you see? Anyone? Very basic question I'm asking you all. What is the most significant change? The most significant change is, okay, in terms of numbers, the core capital or the tier 1 capital requirement under Basel 1 and 2 was 4%. It has gone up to 6%. That's the most significant. From that 6%, a new capital element called common equity tier 1 was introduced at 4.5%. The total capital remains same. Look at total capital. Under Basel 1 and 2, it was 8. Here also 8. So what does it mean? What does it mean? What really has happened? So Basel has kept total capital at 8%. So that has not changed, even under Basel 3. But tier 1 capital has been increased. Within tier 1 capital, new element called common equity tier 1 capital was brought in, which is 4.5%. So what has happened due to that?
Quality of the credit has.
Yeah. So basically, if you look at the tier 1 and tier 2 capital, which is the most stronger quality capital? Tier 1 capital. So the tier 1 capital, which was earlier 4% out of 8%, now has increased to 6%. So within the total capital structure, the bank is required to maintain higher amount of tier 1 capital, stronger capital. And also within that 6% tier 1, another higher quality capital called common equity tier 1 capital need to be maintained at 4.5%. Okay, so that is the new phenomena, the important element introduced by the Basel 3 requirements. Okay, so let me put a small chart. I will come back to this little later again. Now this gives the the improvements in the Basel framework from 2 to 3. So we have a core capital requirement of 4.5%, and also I will discuss a little later, probably next after a few slides. There is 2 capital buffers called capital conservation buffer and counter-cyclical buffer up to 2.5% each. So once the bank is required to maintain those 2 buffers at maximum level, the core capital tier 1, that is common equity tier 1 capital, would rise to 9.5. The tier 1 capital is 6%, plus those 2 will rise to 11%. The total capital 8%, plus those 2 will rise to 13%. So once the Basel 3 is fully implemented, with the buffers, the target capital ratios would be 9.5, common equity tier 1, tier 1 11, and the total is 30, compared to 4% tier 1 and 8% total. So you see the massive improvement or massive increase in regulatory capital requirement under Basel III. But in Sri Lanka, it is different. Sri Lanka, the banks need more capital than that. We will discuss a little later, even more than this requirement with certain buffers. So that's a significant step toward ensuring the stability of banks to sustain any shocks under a systemic crisis, stress scenario. So I will explain the buffers within few minutes. So let's move on to common equity tier 1 capital. Don't worry too much about these definitions. But what is important is common equity tier 1 capital. I have given the elements that has been highlighted under Basel to consider as common equity tier 1 capital. So these are the elements of a bank common equity tier 1 capital that could be considered for computation. Okay. Common shares which satisfy that particular criteria. Stock surplus like share premiums from the instruments, issue of instrument included in common equity tier 1, retained earnings, accumulated other comprehensive income and other disclosed reserves, common shares issued by consolidated subsidiaries of the bank and held by third parties. So there are a number of elements. The regulatory adjustments applied. After that, you have to apply the adjustments in the calculation of common equity. I will explain the particular chart when I, let me see, I think there should be a slide on that, yeah, when it comes to particular direction. Okay. So, additional tier 1, these are the components again. Instrument issued by the bank that meet the criteria for additional tier 1. So there's a criteria set to qualify as different capital components. Common equity tier 1, additional tier 1, tier 2. Okay. So you can only take that particular capital element to the respective component if that satisfies that criteria. Okay. So similarly other elements. Then tier 2. Again, there are elements that could be taken into tier 2, defined, and so you must meet a particular criteria. And if you fall into those criteria, rest of the things would apply. Okay. This is broadly similar. Most of the elements are similar, but there is a criteria to ensure quality. Deduction from capital. So I think when I explain Basel 1, now when you compute the total capital, what you all do is you have tier 1 capital, tier 2 capital, then you add together, then you deduct certain adjustments for the investments in financial institutions. Okay. After that, tier 1 and tier 2, then only you arrive at total capital. So the adjustment under Basel 1 and 2 come in at the time of before the total capital, after the tier 1 and tier 2 capital. But in order to ensure the quality of the capital, the Basel 3 suggests those adjustments is applied in the tier 1 common equity component, not to the overall capital. So that again requires, so because now the adjustment is made at the common equity tier 1 capital, that means you must have a higher common equity tier 1 capital. You see, you need to have higher common equity tier 1 capital. Because let's say you have 100 million common equity tier 1 capital. Let's say if you have 100 million common equity tier 1 capital, under the previous Basel, you will not be adjusted these deductions from that 100 million. That will adjusted after the tier 2. But now let's say you have deductions which I mentioned, 25 million. Now that 25 million is adjusted from the common equity tier 1 capital. So that means if you have 100 million, once these are adjusted, your common equity tier 1 capital will drop from 100 to 100, from 100 to 75, for example. So what does it mean? So if you need common equity tier 1 capital 100 million to ensure that 4.5% ratio, when this adjustment come in, if there is adjustment like this, you must have, you should have more than 100. Because let's say, if your requirement is 100, if you have 100, if there is adjustment of 25 million, what happens? Adjusted amount is 75 so that you can't meet the 4.5% requirement. So in order to meet 4.5% requirement, you must have how much? At least 125. You see? So that means because of this adjustments was brought forward to the common equity tier 1 level, you need to have more common equity tier 1 capital. Means good quality capital. So that again have a significant impact on the quality of capital required by the bank. Clear? Any questions? Okay. Let's move on to the buffers. Now I said when I showed that bar slide, there are two buffers, capital conservation buffer and counter-cyclical buffer. Now, capital conservation buffer is something again made up of common equity amounting to 2.5% of the risk-weighted assets when fully phased in by 2019, means when the Basel was enacted in 2013, with the intention of creating capital buffers in good times that can be used to absorb shocks in period of stress. Okay. So the idea of a buffer is that now in terms of the original or the basic Basel capital requirements, what you need to comply? Tell me, I mean, I'm not referring to Sri Lankan context, but internationally, from what I showed you a few minutes ago, what are the capital requirements you need to comply? You need to comply. What are the requirements? Tell me. Tell me three things under Basel III. We just learned a few minutes ago, a few slides ago. Hope you are with me or you are not sleeping. Tell me what the key three things.
Common equity tier 1 capital, then additional tier 1 capital, and
tell me three
capital.
things, really what you need. I mean, common equity tier 1 capital is okay, but how much? Tell me.
4.5%.
Huh?
4.5%.
Okay. Then
additional T1 capital of 1.5, then altogether 6.
no, additional tier 1 capital is a component, but it's not a requirement, but it will automatically be, you know, fit in, but not that one. There is no requirement. What is the requirement? Three things. common equity tier 1 capital of 4.5% of the total risk-weighted asset, tier 1 capital of 6% of the risk-weighted asset, total capital of 8% of the risk-weighted. So those are the three things. 4.5% of common equity capital, 6% of tier 1 capital, 8% of total capital. So very basic. So the objective of this conservation buffer is you keep additional 2.5% a buffer so that if in a difficult period, if your ratio is going to come down, still you can maintain this 4.5, 6 and 8. So you conserve now in a good period to be absorbed shocks in a period of stress. Because in a stress, your capital is eroded. So in good times, whenever you have good time, good period, allocate 2.5% and keep it as an extra buffer so that you can use the buffer to maintain the bare minimum. Did you get the point? So that means you maintain common equity how much? With a buffer. How much? How much you should maintain?
7%.
Huh?
7%. 7%.
7%. Tier 1?
8.5%.
8.5. Total?
10.5%.
Exactly. So you must have 7% common equity tier 1, 8.5% tier 1, 10.5% total. So once you build up a buffer, let's say bad time comes, you will be subject to losses. So when even losses, then definitely your capital will come down. With the losses, your capital will be eroded. No question of it. But since you have now buffer, even your losses will, as a result of your losses, capital will come down. You can maintain the bare minimum. What is bare minimum? 4.5, 6 and 8. So you are running with 7, 8.5 and 10.5. If you don't have buffer, then you will be subject to restrictions. So let's say your bank is below the requirement with the buffer, then you will be subject to restrictions. Now I have given it in the following slide. These are the restrictions. You cannot do these things: dividends, share buybacks, bonuses, and so on. So, for example, if your common equity ratio is right now below 7% and this range, your restrictions will be as follows. Depending on the level, you will be 100% restricted. If you are this level, you will be 80% restricted. If you are this level, you will be 60% restricted. If you are this level, you will be 40%. If you are until you reach 7%. To ensure you have a sufficient space to accommodate risk. Clear? Any questions? So we'll move to the next part, counter-cyclical. Okay, no questions? So previously we talked about the capital conservation buffer. Now we talk about counter-cyclical buffer. So what is counter-cyclical buffer? A further counter-cyclical capital buffer may be imposed to prevent excessive credit growth. It would be made up of common capital, common equity capital, up to an additional 2.5% of the risk-weighted assets. This buffer is expected to be imposed at a national level, only during times of excessive credit growth and will be allowed to be released during times of credit contraction. Now, idea of this buffer is not to be imposed at all times. Now, conservation buffer you must maintain all times. Now, this buffer will be brought in now in an economy, in the banking sector, whenever the regulator feels there is a very high credit growth, then that is an indication of risk. So what is the risk? What is the risk? You see in certain periods, even in Sri Lanka or many countries, there are excessive credit growths. Now, today's situation is a little bit different. You have very less credit growth. You have enough room for expansion. But certain times, now if you look at Sri Lanka, you see immediately after the war period, 2011-12, there's a massive credit growth. So why there's a risk in credit growth, excessive credit growth? Why you need more capital? Why they impose this during excessive credit growth period? What is the reason?
When the economy reaches to the maturity level, then after which economy will be in a recession period, then in that case the borrowers or will be unable to serve the loan.
Yeah, you can continue. Yes.
Therefore, in order to use in that cases, we need to keep additional capital to absorb that losses.
Okay. So when the credit growth is excessive credit growth means higher demand, despite the capabilities. That's a very bad signal. So generally, it has been observed the credit growth, excessive credit growth in a demand period has followed by significant losses in a subsequent recession, as you said. So excessive credit growth is a signal economies will soon revert into a recession. And during a recession, what happens? Especially if you really look at a good analysis, excessive credit growth is basically many individual consumer-based lending, not for a productive purpose. There are less productive purpose loans and more consumer finance-based loans. So definitely, when the things turn around, because I said we are running in a business cycle. No one of us can change the business cycle. It's ups and down. Economy is going up, come to stability, going down. We can't stop that. Even the developed countries stop that. That is the nature. Only thing is the period is unknown. Now, certain ups comes, certain downs will be after certain period of ups, but which is not a common thing. But definitely ups and downs are there, booms and downs. So when after the credit growth running into recessionary period, what happens? Your businesses will go down, your incomes will go down, then you find it difficult to repay your loans obtained during the boom period. Then you start defaulting. As a result, NPLs of the banks go up. Then as a result, banks need to write off these loans or keep provisions. As a result, bank will incur losses. As a result, bank's capital will be eroded. So that's why this buffer is introduced. Whenever a regulator sees in an economy, in the banking sector, there's a significant credit growth, ask banks to maintain additional buffer common equity tier 1 up to 2.5%. So the regulator has option to decide how much the bank should have based on the recession scenario expected up to 2.5%. It may be 1%, it may be 2%, it may be 2.5%. Maximum is 2.5% at the general national level for each bank. Then what happens? You maintain this, the recession comes, then you have the ability to absorb those losses because you have a 2.5% additional. Okay. So let's say in a situation where the central bank imposes additional 2.5% in an excessive growth period, how much a bank could keep as common equity tier 1 capital? How much a bank could keep as common equity tier 1 capital, as tier 1 capital, and as total capital under the international standards? Tell me. Quickly. How much?
Common equity is 9.5.
Yes.
Then tier 1 is 11%. Then 13% for total capital.
Okay. All right. Because now common equity tier 1, original 4.5, conservation buffer 2.5, counter-cyclical buffer, if it is 2.5, altogether 9.5. Tier 1 original 6%, common equity tier 1, sorry, conservation buffer 2.5, counter-cyclical buffer 2.5, 11%. Total, general or the minimum 8%, conservation buffer 2.5, counter-cyclical buffer 2.5, 13%. So that's what I explained in the previous bar chart. With the conservation buffer, you must meet these requirements. 9.5, 11, 13. So you see it's a significant increase compared to the Basel II. Now Basel II, you need only, you didn't have common equity tier 1. You have tier 1, 4%. Now tier 1 alone goes to 11. More than double, almost about 250%. This one, again, significant increase from 8 to 13. Now within this, again, out of 11, 9.5 must be common equity tier 1, more solid capital. So this is the improvement that was brought in Basel III for the capital requirement. Okay. Then the second thing, now the next element is the liquidity, leverage ratio. Remember, in addition to the conservation buffers, Basel III brought in a leverage ratio. Now, what is leverage? Now, leverage is how much debt against the capital. So it acts as a non-risk sensitive backstop measure to reduce the risk of the accumulation of excessive leverage in the financial institution and in the financial system as a whole. So the leverage ratio is a measure of tier 1 capital against the total assets. Now here we don't use risk weight assets or anything. It's a simple tier 1 capital of a bank divided by the total assets, that is including both on and off balance sheets, so that bank should maintain minimum 3%. Okay, at least 3%. So it's a rather non-risk sensitive measure. So you're not going to put any risk weights or anything like that. Simple tier 1 capital divided by the total assets, both on and off balance sheet. The assets will be treated on a non-risk adjusted basis with limited or no recognition of collateralization or credit risk mitigation associated with assets. That is basically gross basis. We don't consider any collateralization for credit risk. And the leverage ratio should not be more than 33 times of the bank capital, or ratio of at least 3%. So that is the other measure which was brought in under Basel III. So it's very clear now, the Basel III requirements, the capital, the 4.5% common equity tier 1, then 6% total, tier 1, 6% tier 1, 8% total. In addition to buffers, capital conservation buffer 2.5%, common equity tier 1, counter-cyclical buffer, maximum 2.5%, again common equity tier 1. Okay, then this particular leverage ratio. Any questions? No. So let's move on to the direction then. We'll have a brief look at the banking and direction. Okay, so I'm giving the broad overview, but there may be subsequent changes, slight changes as you go in. Now, how in Sri Lanka this Basel III was adopted. Now, this direction, number 1 of 2016, issued under Basel III for commercial banks and specialized banks. So this applied to all licensed commercial banks and licensed specialized banks incorporated in Sri Lanka on a solo and consolidated basis. Branches of banks incorporated or established outside Sri Lanka on a standalone basis. So for domestically incorporated banks, for the bank, also for the group. This direction applied for the bank as well as for the group. But the foreign bank branches here, it will be on a standalone basis for the branch. And so I'm not going to very much details. The broad picture I will put in. If you want, you can go through this particular direction in detail when you have leisure time. So like in international standard, we also have tier 1 capital, 2 components, common equity, and the additional tier 2 capitals. Okay, and also to compute risk-weighted assets, it has been given that following approaches are allowed. For the credit risk, standardized approach. For the market risk, as I said, the standardized approach. For the operational risk, the basic indicator approach or the standardized approach. And also there is a little deviation from the standardized approach introduced what is called alternative standardized approach. So these are the requirements under the direction. Then the capital buffers, like I explained under the Basel, It has been introduced capital buffers, conservation buffer, and also there's a slight different. There's a capital search for DSIPs. Okay, for licensed banks with total assets so equal to greater than 500. This is original direction. Then recently there would have been certain changes, which I'll try to pick during the next session, possible. So there is what we call capital surcharge for DSIPs. DSIPs means domestic systemically important banks, considered as base of asset base of more than 500 billion. Then counter-cyclical buffers, okay, based on the credit growth, okay. Then the implementation standard is like this. How in 2016 it was suggested. Now it is fully implemented. So I have divided into two categories because the DSIPs is above 500 billion, different level of application. Now this is not DSIPs below 500 billion. The requirements are, I will not discuss these things because when the original 2016 direction was introduced, they set the framework from beginning 2017, but now we are in 2021, so this is fully applicable. CET1 4.5 like Basel, CCB counter-cyclical capital conservation buffer of 2.5. Then together 7. Then minimum tier 1 is 8.5 with the buffer. Then minimum total capital is 12.5, okay, with the buffer. So it's different to the original Basel, because Basel only required to 10.5. Here, in our case, it is a little bit different. The total capital is additional margin. Okay, this is without counter-cyclical buffer. So in case where the central bank introduce a counter-cyclical buffer up to 2.5%, then you have to add that as well if it is implemented. So this is without counter-cyclical buffer. So this is for a DSIP, domestic systemically important bank, with the asset size is 500 billion or above. So minimum CET is same, CCB 2.5, that's again same. Now there's an additional surcharge of 1.5. So the tier 1 is 10 now. Total is including the conservation buffer and surcharge 14. So a Sri Lankan bank with 500 billion above or considered as domestic systemically important, the requirement is minimum 14%. So significant requirement without buffers, without the counter-cyclical buffer. Yeah. So these are the requirements. So there are other requirement sets in the direction. I am not going to discuss each and everything because it is time. You can read those requirements. The difference between capital ratio and the tier 1 can be met with tier 2. So the difference between the tier 1 and tier 2 can be met with tier 2 total and there are conditions. The bank shall raise tier 2 capital only up to 100% of CET1 capital. So the maximum tier 2 capital a bank could raise is limited to 100% of the CET1 capital to ensure the quality. So there are certain conditions with respect to capital instrument which were there earlier. So these are the requirements and the format also given. I'm not going to discuss. Then capital conservation buffer, again the bank has given, the central bank has given the features. Key features, CCB have been drawn during period of stress, shall be rebuilt by way of reducing risk stress distribution of earnings. Discretionary distributions may include dividend payments and share buybacks. Additional capital may be raised from the market to conserve internally generated capital. Future predictions of recovery will not be accepted as justification for maintaining generous distributions when capital buffers are depleted. Fall in CCB in normal times due to increasing risk-weighted assets without a commensurate increase in CET1 capital ratio will require increase in the buffer to the desired level. So these are certain requirements set in. Now again, as I mentioned in the previous slide, if you don't meet the capital including CCB, then you are subject to these restrictions. I showed you earlier the general Basel III restrictions. So this is how it applies in Sri Lanka in case of our banks. So this is for the CET1. This is for the total. Okay. Other key aspects of the CCB, capital conservation buffer requirements. So these are the things subject to restrictions: cash dividends, share buybacks, payments which do not result in depletion of CET1 capital are not considered as distribution. So anything, any payment considered as depletion is included, but not resulting depletion is not included, though it's excluded. Okay. Then this is the capital surcharge for domestically systemically important banks, DSIBs. So original direction, it was identified as 500 billion and over, but there may be slight change for the definition of DSIBs now. So the idea is that DSIBs must have a higher capacity for loss absorbance, so that since they are significant, they must need higher capital adequacy ratio. So this is the 1.5% DSIBs introduced against DSIBs additional surcharge. Again, if the bank cannot meet DSIBs ratio, then there are again restrictions apply for the CET1. Okay. At different types of fine. Now these all have changed by now because already the direction is fully implemented now. So these were the features in 2016 when it was introduced. Okay. Again, the directions specify the supervisory review process, which I explained under the Basel III framework. But here our direction says in Sri Lanka how your banks could comply with. Okay. Again, objectives are given clearly. The evaluate the ICAP process. Okay. So ICAP, that banks use ICAP in more general business decision and budgets, in more specific decisions, and so on. The principles, again in Sri Lankan direction, how these principles applies for the Sri Lankan banks, the same as I mentioned. The principle 1, the banks shall have a process for assessing their overall capital adequacy in relation to the risk profile and a strategy for maintaining their capital levels. The pillar 2, the supervisor's job. Central Bank of Sri Lanka as the regulator will review and evaluate banks' ICAP and strategies, as well as its ability to monitor and ensure compliance with regulatory capital ratios. The third one, regulatory capital, the capital above the minimum. CBSL expects, the Central Bank of Sri Lanka expects banks to operate above the minimum regulatory capital ratios and requires banks to hold capital in excess of the minimum. Principle 4, CBSL will intervene at an early stage to prevent capital from falling below the minimum levels required to support the risk characteristics of a bank. So in the Sri Lankan direction, so this those principles are aligned in the Sri Lankan context. I am going a little bit fast because you can go through this direction in your free time. Then the market discipline. Remember, I said I will come to the market discipline along with the direction. Okay. The third pillar of Basel II. So let's look at the minimum disclosure requirement under the Basel III. The Pillar 3 aims to complement the minimum capital requirement and supervisory review process by developing a set of disclosure requirements which will allow the market participants to gauge the capital adequacy and risk exposures of licensed banks. So it aims to complement the minimum capital requirements and supervisory review process by developing a set of disclosure requirements which will allow the market participants to gauge the capital adequacy and risk exposures. Okay, so this is something to complement Pillar 1 and Pillar 2. So that these requirements will improve the comparability and consistency of disclosures among licensed banks and facilitate assessment of the bank by others, including investors, analysts, customers, other banks, and rating agencies, which leads to good governance. So the objective is give through standardized disclosures among all banks in terms of regulators' requirement. The regulator, the banks publish a consistent set of data which could be compared by relevant parties, such as investors, analysts, customers, other banks, and rating agencies, as a good governance practice. So disclosures under these standards requirements broadly include the regulatory capital requirements and liquidity, risk-weighted assets, linkages between financial statements and regulatory exposures, risk management, and a discussion on adequacy of meeting current and future capital requirements. So what is the purpose? When the minimum disclosures are made for the public requirements, how it impact the bank? So what is the importance? Why? Now we know Pillar 1, regulator says you need this much of capital minimum, CT1, Tier 1, and total. Then you must comply. Pillar 2, for principles, some are relevant to the regulator, some are relevant to the bank, you must do that. But when the regulators ask banks to disclose certain things under Pillar 2, how does it impact? What benefits that bring in terms of the risk management of banks? How it impacts? So I mean, having a Pillar 3 will not be useful if it's not impacting anybody. So how it is being useful? Tell me, how the linkage? What is the linkage? Disclosure requirement, discipline. Anyone? Any thoughts, any views? No. How it links to the risk management, disclosures. What is the benefit a bank would have? Why Basel thought of having this pillar? Now, what you are supposed to disclose on different aspects, now here given, the regulatory capital requirements and liquidity, risk-weighted assets, linkages between financial statements and regulatory exposures, risk management, and a discussion on adequacy meeting current and future capital requirements. Now, when you are asked to publish this information to the public in broad media, what sort of information would you like to appear in the public domain as a banker? What sort of information? What sort of information as a banker would you like to appear on the media in the public domain? Anyone? Are you all in the lecture or you have left the class? What sort of information would you prefer to appear in the public domain, the media? Any thoughts? Anybody is there in the lecture? Can anyone tell? What sort of information would you like to be in the media with respect to those elements? Do you want to publish good information, positive information, no? Bad information, negative information? Let's say now we have seen in media when your annual reports are out, profits are disclosed. When you have billions of profit, how do you put it in the media? Maybe around one page, big letters, to put, okay, our bank has earned this much of profit, billion, so much billion last year, profit after tax. Your growth is this much, NPLs down. Let's say in a particular financial year, you may incur a loss. So would you inform to the public in the same way? In a one page, I have incurred a loss of 5 billion. Would you put advertisement like that in the media when you do for the profit in the same way? No. You will try to not to disclose if you have a loss. You will not say big letters, one page. I have incurred 5 billion loss last year. In big letters, you will not do that. But that will give a bad signal, badly affect you in terms of public reaction, depositors' reaction, stakeholders' reaction, rating agencies' reaction. So when you are, let's say you are not supposed to disclose information, then you are not worried. Because it's only known to the regulator and yourself. But public or the other stakeholders won't know about it. But when you are asked to disclose certain information about your risk, capital, and other aspects, then public will do assessment between banks. That's why these requirements will improve comparability and consistency among the banks. So the public have opportunity to look at the different banks, how they have fared in respect to liquidity. Now they will look at your bank. Okay, I have my deposits in the bank. Now, what is the liquidity? What is the risk level? So when I see my bank where I have transacted from a depositor's point of view or other stakeholder point of view, I will move away doing business with you. So there's a greater risk for the banks in terms of public, reaction if you have a bad information. So when the disclosure requirements are brought in, it is a natural incentive given to the banks to ensure you have good information. Good information means you are compliant with the requirements, or your indicators are broad, strong, so that you can manage public confidence. If you have bad performance, bad indicators, publish or disclose, then public will react badly. So you have negative consequences. So by having good information, now you can't escape because regulators say you must under Pillar 3. If there was no Pillar 3 requirement, you could have got away. But now Pillar 3 is disclosed periodically. So we look at them later. So that gives you another requirement so that you have your internal governance so that you have good performance to ensure you are in par with other competitors, other banks, which will not affect your business negatively by public or the stakeholders. So let's look at what are the, I have only given the broad picture, but there are detailed elements to these requirements if you look at the direction, because my purpose is not that. But if you want to enhance your knowledge further, please go through the direction, which is more comprehensive. But I have extracted a couple of slides about the broad requirements for Sri Lanka. So these are the broad requirements, the regulatory requirements on capital and liquidity, the capital and liquidity ratios, Basel III computation, Basel III computation of, capital ratios, Basel III computation of liquidity ratios, Basel III computation of liquidity coverage ratio, and of course now the NSFR, the main features of regulatory capital instruments. So the features. So you have to publish certain information weekly, certain information annually. Okay. Certain information quarterly, certain information annually. And also where you publish. Now the P stands for press. Press means the media. W stands for web. So at least in your websites on quarterly and annual basis, it's a must, you must publish. But certain information you need to publish in the press as well, annually and quarterly. So the next piece of information, summary discussion on adequacy meeting current and future requirements annually in the annual report. A means annual report, and B means W means the website. The credit risk under standardized approach, risk exposures and mitigation, again quarterly and annually, quarterly in the web, annually in the annual report and web. Then credit risk under the standardized approach, exposures by asset classes, annual report, and the website annually. The market risk under standardized approach, quarterly on the web, annually in the annual report and web. The operational risk under basic indicator approach, the standardized approach, or the alternative standardized approach, quarterly in the web, annually in the annual report and web. Then the linkages between financial statements and regulatory exposures. Sometimes there may be a difference in certain financial information reported as per the accounting standards and the regulatory standard. Now, for example, your annual reports are prepared under the IFRS 9 requirement. So the things like the provisions, the fair value assessments are different from what is required by the regulator, because they follow the IFRS accounting standard, but you may have different standards for the regulatory requirements. So if there is a difference, so identify the linkage. Otherwise, the people may not have a proper idea. Then explanations of differences between accounting and regulatory exposures you have to disclose. The bank risk management approach, how you are going to manage risk. So that will give some comfort about your bank's ability to sustain risk for the public. So public will look at, if they really look at, they will react depending on your risk management principle. Risk management related to key risk exposure. So those are annual informations to be published in the annual report and website. Okay. So this will give some discipline to the bank so that the bank will try to ensure you are managing your risk at a comfortable level and also your capital adequacies are comfortable, so that when the public or the stakeholders see that, it will give a positive signal. So by chance, if you don't manage your business properly and your risk levels are high, capital adequacy levels are low, so when you are published, it will have a negative impact and also negative consequences. So that is the very important part in terms of the disclosures. So that's why Basel 3, Pillar 3 is important. So we have broadly covered today the Basel 3, Pillar 1, Pillar 2, Basel, under Basel 2, it was started from Basel 2, but now under Basel 3, again continuing with more, capital requirements, as we saw. So that Pillar 1, Pillar 2, Pillar 3, three different purposes. Pillar 1 is minimum regulatory capital set by the regulator. Pillar 2 address broad risk assessment by the bank and ensure the capital is aligned with the internal risk through the ICAP process. Pillar 2 basically talks about the economic capital. Then Pillar 3, of course, we just now looked at the market discipline, where the banks are required to disclose certain information with respect to capital and risk to the public through the different modes of publications on quarterly and annual basis, through the website, through the annual reports, and in the press, so that the stakeholders and the public can take informed decisions, because the process is transparent, consistent. So they have an opportunity to compare among different banks so that they will take judgmental decisions, or they have the ability to take judgmental decisions based on the information you publish. And also we looked at the general Basel 3 elements of different capital requirements, CET1, Tier 1 and total, and the two buffers and the leverage ratio. And also we were looking now how those are being applied in Sri Lankan context. This particular direction issued in 2016, but of course there have been certain changes during the process. Of course, all of you know, I just brought in the original direction for the to ensure that how this was implemented in Sri Lanka, consequent to Basel 3 adoption internationally. So I think with that we can conclude the session today, because we have almost reached time 12:30. But next day, before we start the new session, I will simply go through the direction key components for the elaboration, how in Sri Lankan direction, describes different elements of equity capital, Tier 1 capital, CET1, total capital, and how the risk weights are computed as per the direction. But if you have opportunity to read the direction, probably you will understand, but this is for your explanatory purpose. I will touch on few slides probably next day before I move on to the next session. Any questions before we stop? So with this, I think you should be comfortable with Basel capital requirements or the Basel framework in relation to the risk, because my focus was not just the Basel, how the Basel framework tried to address risks. Because our course program is about risk management, integrated risk management. So how the capital adequacy framework captures risk under the different contexts of starting from Basel 1, Basel 2, and Basel 3. Any questions before we stop for the day? Probably we may have a couple of lectures. I can't give any assurance we can finish next time because probably we may have a recap session lastly. So probably next week and one more week. It looks like that. So basically, you must be thorough with the entire program work so far done. So you should be able to sit for the exam soon, including my area and also area from the other resource person. Be thorough so that you can sit for the exam without it. Any questions?
So one more thing for the clarification. Yeah, one of the weaknesses from the Basel II was excessive leverage, under which the bank was permitted to leverage their balance sheet by keeping off-balance sheet assets.
Okay.
Then under which there is a separate thing called special purpose vehicle. What do you mean by that? That expression?
I couldn't get, but there is no weakness in the Basel II because it is a new element to address leverage factor under Basel III is leverage ratio. Okay, what do you, I can't, where is that special purpose vehicle?
Yeah, there is actually I am referring to a particular reading book.
Yeah.
They have expressed that the bank has permitted to leverage their balance sheet by holding asset in off balance sheet through the special purpose vehicle.
Yes. Okay.
Then I think I didn't get what do you mean by that special purpose vehicle?
Difference is without looking at the particular this thing I can't say, but I think it's different now. Things like this. Now under the now I mentioned the Basel II did not capture things like securitizations. Remember derivatives. At the beginning I said, I think if I can go back to the particular slide, I made a reference to that. We go to that one. Yeah, now if you look at this slide, inadequate capital to capture risks arising from bank exposure to securitizations. You know, so in a securitization process, what happens is basically you sell your loan book through a special purpose vehicle or trust and create liquidity so that your risk weight is minimized through that process. Because you know, securitization, what you do is you select a particular portfolio of asset, you sell it, or you issue a new bond against that pool through a SPV or trust. So then you create a new liquidity through that pool, and probably you apply a lesser risk weight. You know, so you transfer your assets to a special purpose vehicle through a securitization process and create more liquidity and do more lending. Instead of, you know, your risk is reduced, but it creates more, you know, higher risk in terms of lending. So probably, you know, the reference is like, you know, what you mentioned is to such a, you know, transaction where special purpose vehicle or trust is created for the purpose of securitization. As a result, bank try to hide the actual risk so that their requirement for capital is reduced. But in effect, that's a risk event. Clear?
Yes, sir.
Okay. So probably that is the reference, I think, special purpose vehicle. Okay. If you don't have anything, we can stop for the day. So we'll meet again next week, next Sunday at 8:30. Okay.
So excuse one more thing. You have any idea of the mode of the exam? Is it going to be an online exam or a?
No, that's a physical exam.
Right.
It's not a more online, it's a physical exam. Hopefully, that's what I understand, but we'll let you know. As I understand right now, it's a physical exam. Okay. Okay, then we'll stop here and let's look at the new area next day. Thank you.